US growth is set to miss a 3% annualized rate this year, despite economists' belief that 2014 was the year the US recovery would get into gear. The economy has rebounded from the harsh winter, but the susceptibility of the economy to adverse weather and pronounced pocket of weakness hint at the underlying weak points of this economy. The most obvious weak point is the US housing sector, which the Federal Reserve has singled out as the greatest threat to the domestic recovery. The subprime crisis left a permanent scar on the US psychology that has led to a structural shift to a more risk-averse and deleveraged American consumer. The example of the housing market sets a dangerous precedent for the entire US recovery. The housing market recovery was the result of aggressive monetary policy, and the tail risk is that the overall US recovery will stop as soon as interest rates rise. There is an obvious but worrying conclusion to be made from lacklustre wage growth and the contradiction between growth that disappoints and a robust labour market recovery. The US is a less productive economy. This has dangerous consequences for the US's long-term potential output growth. This is something that the Fed and the Consensus Bureau have inadvertently admitted to by revising down the US's long-term growth to the 2% range. In recent weeks, financial markets have scrambled to place bets the Federal Reserve will soon hike. Their expectation seems rational. However, the Fed need complete certainty before they begin the tightening cycle. And we expect the Fed to stay well behind the curve and are only predicting the first rate hike in December 2015. The stronger dollar has been the trade everyone was waiting for and was long overdue. As the Fed ends tapering and US monetary policy comes back into focus, the dollar will be a key driver of global FX. 2015 will be reminiscent of the taper tantrum in 2013, as the financial market watched the Fed's every move.